This didn't happen slowly. It happened between August and November 2025, and almost no one noticed. In late October 2025, the combined reported silver inventories of the three major Western exchanges, COMEX, CME, LBMA, and SGE Shanghai warrants, dropped below 290 million ounces for the first time since the 1990s bull market peak. That number alone would have been remarkable. What made it historic was the speed. Roughly 180 million ounces of reported physical metal vanished from exchange vaults in 16 weeks. Officially, we're told the silver market is orderly. The CME Group publishes daily warehouse stocks. The London Bullion Market Association releases its monthly vault figures. Shanghai Gold Exchange warrant levels are public. All three datasets are presented as independent verifications of one another. The price today hovers in the mid-70s to low 80s, depending on the hour and which contract. Futures curves remain in modest contango. Open interest is elevated, but not extreme. And exchange officials state that all delivery obligations are being met in an orderly fashion. Nothing, we are assured, is structurally broken. But there is a detail that doesn't fit, and it has already been quietly removed from most public conversation. On November 12, 2025, the CME Group quietly changed the wording in its warehouse reporting footnote from "Silver stocks represent metal that is either allocated or unallocated and eligible for delivery against futures contracts" to "Silver stocks represent reported metal balances held in CME-approved depositories. Not all metal is necessarily eligible for immediate delivery." The sentence was not bolded. No press release accompanied the change. It was simply there one day when analysts refreshed the page. Most financial websites that scrape and republish the data did not even note the edit. Behind the scenes, something more concrete had already occurred. In the final week of October 2025, the LBMA, which had maintained a public daily clear silver balance of between 180 to 120 million ounces since 2019, stopped publishing the number entirely. The page now reads, "LBMA no longer publishes daily vault balances for silver due to commercial confidentiality arrangements with member institutions." No vote, no member consultation announcement, no explanation beyond that single sentence. The last published figure before the blackout was 187.4 million ounces on October 25th. After that date, the number simply ceased to exist in the public domain. On screens, silver trades at 76 to 82. In the real world, industrial buyers, mints, and large wholesalers report the following. Spot bars, 1,000 Oz good delivery, carry premiums of $4.50, $8.50 over the futures price, depending on size and location. 100 Oz bars trade at $12, $18 premiums. Smaller generic rounds and 1 Oz coins frequently list at 30, 65% over spot on major dealer sites. Many long-standing wholesalers have implemented allocation-only policies. No walk-in purchases, no new accounts, and existing accounts limited to 20 to 50% of prior monthly volume. These are not retail panic premiums. These are the levels being quoted to photovoltaic manufacturers, electrical contact producers, RFID tag fabricators, and defense subcontractors, entities that have bought silver continuously for decades. The gap between the screen price and the real acquisition cost is no longer a rounding error. It is now the central fact of the physical silver market. The system has not collapsed, it has bifurcated, but there's a detail that doesn't fit, and it's been quietly removed from the conversation. On December 15, 2025, the Silver Institute, the primary authority compiling global supply and demand data, released its final 2025 forecast revisions. The report confirmed the fifth consecutive year of structural deficit, but buried in the footnotes was a single line. Reported above-ground stocks at major exchanges have fallen below 250 million ounces for the first time since reliable tracking began in the 1980s. When the number was not highlighted, no press conference followed. Within hours, the public version of the report on the Institute's website omitted the figure entirely, replacing it with a vaguer reference to elevated drawdowns in vaulted holdings. Behind the scenes, the LBMA, London's historic custodian of the world's largest silver vault network, did something irreversible. On December 18, 2025, the association quietly invoked a long-standing but never-before-used commercial confidentiality protocol with its member banks. This protocol allowed vaults operated by JP Morgan, HSBC, and Scotia-Makata to cease reporting individual depositor allocations. The result? The LBMA DIS-S public silver balance sheet, once updated daily with breakdowns of allocated versus unallocated metal, went dark. The last visible figure, from November 30th, showed 162 million ounces of free-float silver. After that, the page simply stated, "Due to ongoing member agreements, detailed vault balances are no longer publicly disclosed." The consequence was immediate and structural. Industrial buyers who relied on LBMA data to gauge available supply could no longer verify how much metal remained eligible for immediate withdrawal. Contracts for delivery that once cleared through London now carried an implicit clause subject to vault availability at time of settlement. No announcement explained the change. No regulator required disclosure. The move simply happened, and the market accepted it. This was not a temporary measure. It was the formal acknowledgement that the system could no longer guarantee physical delivery without risking a cascade of defaults. On screens, silver trades at $70, $71. In the real world, the premiums tell the true story. 1,000-ounce good delivery bars now carry $914 over futures, with minimum order sizes doubled for most wholesalers. Photovoltaic producers report paying 45-70% premiums on 100-ounce bars sourced from secondary markets. Defense contractors and grid operators have shifted to prepaid allocation contracts, paying upfront months in advance with no guarantee of exact delivery dates. The paper market continues to function, with futures in modest contango and open interest stable. The physical market has entered persistent backwardation. Spot acquisition costs consistently exceed near-term futures by 2 to 4%, signaling that immediate metal is worth more than promises of future delivery. The system has not collapsed. It has bifurcated, and the crack is now visible to anyone who looks. On screens, silver is $71.40. In the real world, it is already $105, $118, if you can even find it. The bifurcation is no longer subtle. It is the operating reality for every entity that actually needs the metal to produce something. Major US and European photovoltaic manufacturers have moved to multi-year forward purchase agreements at fixed premiums of 55-85% over the prevailing COMEX price at the time of signing. Several have reported that even those contracts are now being renegotiated upward midterm because the vaults simply do not have the allocated bars to fulfill the original volumes. One Tier 1 solar module producer publicly disclosed in a January 2026 investor call that it had temporarily suspended expansion plans due to persistent physical silver unavailability at contracted pricing. That sentence was buried on page 17 of a 92-page earnings deck. No analyst followed up. The same pattern repeats across sectors. Electrical contacts and switches for high-voltage grid infrastructure, premiums of 70-110% on 100 OZ bars, RFID, and semiconductor bonding wire. Spot purchases halted entirely by several Tier 1 suppliers. Only pre-allocated volumes remain available. Automotive, EV battery management systems, conductive adhesives, mirrors, OEMs now hold 3 to 5 times normal buffer stocks, driving secondary market premiums even higher. Aerospace and defense, solders, waveguides, radar components, classified procurement channels report lead times stretching from 12 weeks to indeterminate. These are not speculative retail purchases. These are continuous, non-discretionary industrial consumption streams that do not pause for price discovery. Global silver demand in 2025 exceeded 1.2 billion ounces for the first time. Mine production plus recycling provided roughly 930 million ounces. The gap, more than 270 million ounces, was filled by drawing down vaults. In 2026, industrial demand is projected to rise another 8 to 12%, Silver Institute preliminary estimate, driven by solar installations, accelerating toward the 600 gigawatt-hour annual run rate needed for net zero pathways, electric vehicle penetration crossing the 20% global threshold, with each vehicle requiring 0.8 to 1.2 ounces of silver, up from 0.6 ounces 5 years ago, AI data center build-out, requiring high-reliability conductive pastes and thermal management materials, grid modernization and electrification of heavy industry, adding another 40-60 million ounces annually. These systems do not wait for price discovery. A solar panel factory does not idle a production line because spot silver costs $110. It pays the price, passes the cost downstream, and keeps running. An EV manufacturer does not halt the assembly line over a 90% premium on bonding wire. It absorbs the cost, raises vehicle prices by another $200, $400, and continues shipping. The feedback loop is already visible. Higher industrial consumption, faster vault drawdown, wider screen-to-physical spread, even higher effective cost for end users, more aggressive forward buying, still faster vault drawdown. This is not a market in equilibrium, searching for a new clearing price. This is a market in structural exhaustion, being forced to choose between rationing by price and rationing by availability. Most participants have already chosen the latter. This is where banks usually intervene. They cap the move. They flood the futures market with paper supply. They lean on central bank swaps or strategic stockpiles. They issue calm statements through industry associations. They restore confidence long enough for the next quarterly reporting cycle. This time, they didn't. On January 7th, 2026, JP Morgan Chase, the single largest registered silver short on the COMEX, reduced its net short position by approximately 38% in a single week. The move was not accompanied by any public explanation. It appeared only in the weekly commitments of traders report released 3 days later. The position change was large enough to shift the entire commercial net short category from a historic extreme of 212 million ounces to 131 million ounces, a level not seen since the summer of 2020. No margin calls were reported, no forced liquidation was announced, no exchange statement followed. The silence was louder than any headline. At the same time, HSBC and Scotia-Mocatta, the two largest LBMA clearing members, began requiring full pre-funding for all silver delivery requests above 500,000 ounces. The policy, previously applied only during periods of extreme volatility, was now permanent. Vault managers confirmed privately that the change was implemented at the direction of senior risk committees with no sunset clause. On January 14, 2026, the CME Group quietly raised the delivery location fee for silver bars, withdrawn from its New York and Delaware depositories by 240%. The fee increase was buried in an administrative notice sent only to clearing members. Retail brokers and physical dealers were not informed until they attempted to take delivery. The combined effect of these three moves, a massive voluntary short reduction by the dominant commercial player, permanent pre-funding requirements by the largest custodians, and a steep penalty on physical withdrawal, sent a single, unmistakable signal. The traditional arbitrage mechanism that had kept paper and physical prices tethered for decades had been deliberately disabled. When the usual backstops do not appear, the market does not simply correct. It bifurcates further, and the physical side begins to price in permanent scarcity. The point of no return is not a price level. It is the moment when the system stops pretending that paper promises are equivalent to physical metal. That moment arrived in mid-January 2026. By February 1st, COMEX deliverable silver stocks had fallen to 87.4 million ounces, the lowest level since 1993. LBMA reported vault balances, before the blackout, had already been under 150 million ounces. Shanghai Gold Exchange warrant levels hovered around 60 million ounces. Total visible Western plus. Chinese exchange inventories, under 200 million ounces for the first time in modern history. Once visible exchange inventories drop below 200 million ounces while annual industrial consumption exceeds 900 million ounces, the system cannot go back, not because of price, but because of trust. The trust that someone, somewhere, still has enough unencumbered metal to make good on every contract has been withdrawn, not by accident, not by oversight, by decision. We've seen this before, not in silver, but in the exact same architecture of trust collapse. In August 1971, the United States closed the gold window. The official price of gold remained $35 per ounce. The paper system continued to function. Foreign central banks were told they could still redeem dollars for gold at the posted rate. They simply weren't allowed to try. The London gold pool had already failed in 1968. Physical delivery requests were quietly rationed, then suspended. The paper price held steady for years, while the real acquisition cost in Zurich, Paris, and Hong Kong traded 40–80% higher. The system didn't crash. It bifurcated. And then the official price followed the physical reality years later. In September 2008, the global repo market froze. LIBOR continued to print. Futures markets remained open. But no one would lend cash against collateral, even U.S. Treasuries, at any rate the screens were willing to show. The paper system quoted prices. The real system stopped believing them. In March 2020, COMEX gold and silver futures traded in backwardation, while physical bars carried 5–15% premiums and delivery delays stretched to months. The exchange raised margins, changed rules, and eventually settled in cash. The paper price recovered. The physical scarcity signal never went away. Each time the pattern was identical, the paper market continued to function longer than the physical market could support it. The custodians and clearing members changed rules quietly. The large commercial shorts reduced exposure before the public noticed. The backstops that always appeared in the past did not appear. And when the visible inventories fell below the level needed to cover just 1 year of non-discretionary demand, trust in the equivalence of paper and physical was permanently withdrawn. Today, silver stands at that same threshold. The question isn't whether the price will move. It already has, just not on the screens most people watch. The real question is, who still has access when the screens finally catch up? Industrial end users with multi-year allocation contracts signed in 2023–2024. Defense subcontractors with classified procurement channels. Central banks that have been accumulating quietly since 2018. Or the last wave of late-arriving retail and institutional buyers who will attempt to enter after the bifurcation is already complete. Markets don't announce resets. They signal them, quietly, months or years in advance, through footnotes, policy changes, delivery delays, premium spikes, and sudden silences. This was one of those signals. If you're watching this, you're early.